YouTube, we are back. How we all doing? It is Inter-Equity Trading coming back with a brand new video. Today is going to be a special one. Not only is there a bunch of value packed into this video, this is one of my biggest trades ever. $13,000 made in a single trade shorting gold. As per usual, I'll be breaking everything down from the higher time frame down to the lower time frame, and I really want you guys to pay attention to the direction, the bias. Being able to find the entry isn't the hard part. Being able to identify the bias is where people struggle the most. If you guys enjoy these videos, please leave a like, a comment down below, and let us know what you guys want to see next. Enjoy the video. All right, guys, so I'm really going to emphasize starting from the higher time frame. So here we are on the hourly time frame. Gold has had a big sell-off from all-time highs. Look to the left-hand side. I want you guys to focus in here. We can easily identify liquidity. Now, why do we view this to be liquidity? Very simple. We take out a high, price trends to the upside, taking out highs here, here, and eventually trades all the way back down, respects this low we have the blue line at once, twice, three times, and then finally we move away to the upside. So we've simply left liquidity below this low. So once we do that, we can easily identify that now. Just simply draw a line. This is going to be a level of liquidity used for the future. Whether you're going to buy below or sell into it, it depends on the setup, of course, but 39.41 is going to be an area of interest. If we now focus in on the current picture we have here, I'm going to open up the 15-minute time frame so we can make sense of what's going on in this picture. One thing I can understand is how we've had a sell-off to the downside. We printed a low, a high, and then another big sell-off down. After that, the market went bullish and did what? Took out previous highs, which is now trap sellers, but not only is it trap sellers, but this is now induced buyers into the market. Why do I say this is induced buyers? Since this high is an area that retail is going to be marking out as an area maybe they call as a BOS. If they view this to be a BOS, where are they going to be buying? Very simple. We understand this. They're going to be buying down at the lows. So this is very simple stuff now. If we have the knowledge of that, we understand buyers are stepping in here and stepping in here. Look how the market moves away. So same concept that we just applied to the left-hand side over here is going to be used over here again. Liquidity below this low here at 4,004.28. If you guys have been watching previous videos and have been understanding how we trade overall, you'll understand that this area shouldn't be ran per the system. Why shouldn't it be ran? It's taken out a level of liquidity. Therefore, why is that going to have liquidity above it? Why is this high going to hold liquidity? It shouldn't, right? Because it's just taking liquidity out. So no one's going to be in the market here. No one should be in the market here. And that's just applying that logic. However, I wasn't taking any entries here, but this is actually a possible area to look for shorts into the buildup of liquidity at the lows. So possible entry up here. Now, I'm going to zoom in more to where I took entries at. But I still want to follow and build that narrative. Okay, so we've had this big sell-off to the downside. Remember, buyers enter positions at the lows down here. Okay, so we have a reason to push lower. We have a reason to sell into these lows, not only these lows, but the ones on the left-hand side as well. Blue lines represent a level of liquidity, okay, an area of interest for us. So we have that big sell-off from the highs, taking out internal lows all on the left-hand side over here. Since price has taken out highs here, highs over here, understand that this now induces more buyers into the market. Therefore, if we get reactions, bullish reactions at the low, view it to be false, meaning buyers are getting in here again. And what does that mean for us? More liquidity at the lows. Okay, I hope you guys are starting to see a common theme around here. And check this out. We go bullish, we grab all of this internal liquidity, and coincidence, look at this. Another liquidity block. Again, same concept that I just showed you over here. Liquidity block over here, liquidity block over here. So another possible entry could have happened in here. So there's one, there's two. Now, the entry I took. Remember, we're bearish and we want to see price to the downside. We understand that every single reaction we're getting out of these areas deem it to be false, short-lived. It's just to induce more buyers, trap more buyers, right? Induce more liquidity to the downside. And then finally, when it's time, price will sell off and grab all that liquidity. I didn't enter these. I did enter the last entry before the move occurred to the downside. So we're going to now follow price in more current PA here. I did back it up. We're in replay mode right now. So I want to emulate live price as much as possible. So we're going to head into the 5-minute time frame. Now, what can we see? Same thing. Look how we've taken out highs here, highs over here, maybe even this high. Understand, why is this important for us? Because any reactions we get at the lows are simply, again, going to be buyers stepping into the market. So look what happened here. Okay, this is good to train the eyes as much as possible. Buyers step in. Understand this to be false. This is not an area we trade from. We want to see retail enter here, though. Reaction up, takes out an internal high. You can mark that on. Why is this important? Well, this could be an area that could be used as an entry in the future. So another LB, right? Another liquidity block. Then we get the sell-off down to the downside, and we grab the lows on the left-hand side. Now, if we continue on with price, look at we're still trading in to the left-hand side. Buyers are entering in this area. Look, if I mark this on, maybe you guys can see a little more clearly. BOS. Buyers entering here. Buyers entering here. Any reactions up, I want you guys to listen here. Any reactions to the upside is only going to provide us an opportunity to sell back down. Any reactions up, again, deem it to be false. It's only going to provide us an opportunity to sell back down. Now, let's make sense of this price action. So if we understand buyers are stepping in at the lows, we want to see sellers get trapped, and then we sell down into the buyer liquidity. Remember, we need to sell once highs are taken. What can I see here? Very simple. I grabbed this high. Now, why did I grab this high? Think about it for a moment. If I mark this on as a BOS, where do you think sellers are entering the market? Think about it logically for a moment. They're going to be entering in these regions here. So we can even mark this as like a POI for retail. When price pulls back, retail is entering here. They want to see price back down. That's their continuation model. They want to see price pull back and a continuation. The market just simply doesn't operate like that. It does sometimes, but we understand why it does sometimes. It's because it builds liquidity. But these are low probability areas to sell from. We will never participate in areas like this. Now, I know a lot of you guys are going to say, but look, it's a liquidity block of some sort. It does not matter. This is going to be a trap. We do not sell from these areas. I saw this, and I saw this as a beautiful opportunity to take a sell from. Okay, because I understand as soon as this high gets taken, I'm going to mark this as a blue line. As soon as this high gets taken at 4081.87, I now understand sellers have been trapped. Therefore, after that, we have nowhere to go but down towards the buyer liquidity. So essentially taking liquidity at the highs, hunting for the liquidity at the lows. But again, adding that logic, adding that reasoning to your analysis. Stop loss, again, always above the high. I want you guys to understand that. I don't want you to see you guys cheating and putting like random areas to the left-hand side. Don't get greedy. You need to have your stop loss in the most valid area, and that's going to be this high right here. So above this high. Where do we target? I think this is very simple, very straightforward. We have these lows to the downside as being one target. And then, of course, you have the option of holding to the higher time frame target to the left-hand side, just like this. Look how simple this looks, right? Every single, and once we've zoomed out, you guys probably are starting to make sense of this picture more and more and more. Ever since we took out this high, guys, building liquidity to the downside, inducing buyers here, over here, over here. We understand that. Everyone, any reactions at these lows is only building liquidity to the downside. All right. Now, to the entry. This is the easiest part. I need you guys to understand that. Building that bias, that logic, that reasoning, identifying all the liquidity on the higher time frame, that's the difficult part. That's what I want you guys to focus on and study here. So for myself, entry right above this high. This is where I took my sell on gold. So we can go back to the 5-minute time frame. That's fine. Sell is going to be above the high. Once sellers are trapped, we're going to enter the market. And boom, we enter in here. Stop covers the high, of course, always. And let's play this out. So it hangs out above the high for a moment, okay? Then we start getting the reaction to the downside. Perfect. And look at that. Now we start trading to the downside. As soon as this low gets taken out, you have every reason to roll your stop. Okay, so roll your stop here. We'll write this down, rolled stop. Okay, and again, why are we rolling stops? Since we're taking out levels of liquidity to the left-hand side, it's possible for price to have some sort of reaction. So cover yourself, cover your risk. So we're initially risking 160 pips. Now we're only risking 40. So you've cut your risk in half by what? If my math is correct, 75%. And now we're going to zoom out and we're going to let the remainder of this trade play out. Okay. So again, we've taken out some sort of lows here, but remember our targets. Don't forget about our targets here. Clean targets. And there we go. Lows are taken. And check this out. Right before we run to our target, look what we do again. I need you guys to understand this. Look, take out a low to induce sellers. Right? This is a BOS to downside for retail. Seller liquidity at the highs. We stab out that seller liquidity right here. And then we get that move to the downside. And what do we run for? Those lows we've been talking about. Okay. And if I actually get out of replay, I'll show you guys that we actually ran for all of the lows that we were talking about. Okay. Look at this. Grabbing that higher time frame liquidity as well. So again, guys, the entry, it's not the difficult part. Okay, I need you guys to understand that. A lot of you guys ask about entry. I need you guys to focus on the direction, building that narrative, finding that bias, and getting consistent with it. All right, guys, I hope you enjoyed today's video. Going forward, I'm really gonna step up our content, slowing it down a little bit and explaining things as best as possible, which is you guys have probably seen in this video today. If you guys enjoyed, again, please leave a like, comment down below, subscribe if you guys have not yet already. We just hit 15K, so thank you guys so much. I'm absolutely loving bringing all this content out for you guys. I appreciate all of you guys for watching and tuning in. We'll see you guys soon. Take care.